Hello, folks. Hi. In this particular video, I'll be taking you through the revision for your exam. And I'm assuming that you would have at least looked at your lecture notes before even getting on to this particular revision PowerPoint. So there we get started. The key topics that are of high significance from your exam point of view. Right now, I'm starting it off from the production costs, and in relation to that, we need to look at the time factor. So here it is. The very first bits. You must be aware of as to what the time periods mean in economics, which is in terms of how the time period is actually divided into three. The immediate, that is the immediate market period, wherein none of the factors of production can change. Short run is the time period wherein some factors of production can be changed, whereas in the long run, practically every factor of production can be changed. So what is the relevance of this, and how can you make examples relating to this in the exam? If at all you get a question, a very, very simple technique would be just to create a table. To create a table, it is just you can pick up, let's say two sections. Let this be a capital and the labor, L for labor, and then I can just make it 1, 1, 1. It is this easy, So 1, 2, 3, 4. It is just saying which period is it? It's a short run, because one factor is fixed, others are changing. And if I had to talk about the long run, just simply the same idea in terms of, but now in this one, we will just keep everything changing, meaning 1. If I make it 1 and 2 here, maybe I can make it 2 and 4 here, such that the factor proportion or the ratio remains the same. So this is the easiest way of putting up a concept. If you are unable to explain it in detail, you can always put an examples like that. So short run and long run, the difference between the two must be clear to you. The next is the productivity, of course. This is relating to the law of diminishing marginal returns, especially. And if you recollect, we had discussed in detail how marginals have an impact on the totals and the averages. But if you keep applying more and more of variable factors to a fixed factor of production, the additional output eventually declines. Remember, the word marginal is additional. Yeah, so each time the additional output declines, and here you can see that how after the second labor, in fact, more or less, the output starts declining here. So this is, and in context of the cost, just putting the diagram here, if you had to start it off. Okay, my screen is stuck right now. Okay, there we go. Here it is. If you had to do the cost, this is marginal cost. So this is like a tick here, and this is the cost. This is quantity. So you can see at this point, this is the point from where where the output is declining. Typically, that is where the cost starts increasing, the additional cost. So it's the same concept. That is the law of diminishing marginal returns. Economic profit. Now, this is a concept that is quite important from your examination point of view, plus in terms of your understanding for the concepts of market structures and the costs and the revenues. So in general, you know that the profit is the total revenue minus the total cost. And what's total revenue? Price times quantity, yes? And the cost is fixed cost plus the variable cost. That's equal to profit. However, there's a very important distinction when it comes to the accounting profit and the economic profit. Economic profit relates to any revenue that is exceeding the opportunity cost, because in economics, we consider even what we forego as a part of our cost. So let's say, just a very nano example, if I'm starting to have my own institution to teach, and in that institution, if I start working and start teaching for my own students within my institution, naturally, I may have to be giving up my work. So the work that I give up and the earnings that I would have got through that is a part of my opportunity cost. So explicit cost and implicit cost. So explicit is like, what you are really paying for. So if you're paying for, just now in my example of my institution, if I'm paying for the tables, chairs, the wages to other teachers, or the whiteboards or whatever, that is all a part of explicit cost. But the implicit cost is what I have given up in terms of my own work, or maybe I'm using my own property which I could have rented out. So if I'm giving up a rent on that, about say $4,000-5,000, that is again a part of my implicit cost, because I'm using my property now for my institution there. So just remember, explicit plus implicit. So implicit is like opportunity cost, if you can recollect. Explicit plus implicit in totality in reality is the opportunity cost. So as you can see, this example will come very handy. Try and have a good understanding of this. If you get a question, it is again, as I suggested before, always a good idea to just post a little example if you cannot explain it more in detail. The bottom line, explicit cost is the cost for the goods and services that you explicitly pay for. Implicit is the cost for self-owned goods and services. Now, this is yet another important section, that is relationship between marginal and the average variable cost. It is important because we did say how marginals actually affect the totals, and you know that the averages are always taken out from the totals. And that is why the marginal cost and average cost and marginal cost and average variable cost uh, are well related. I'll take you through the next bit in terms of the relationship. A very easy way of remembering this whole idea could be, you just need to write down AVC. Just write down MC, MC, and MC. Now you can remember this. This is my MC, that is the marginal cost, and this is my average variable cost. So you can see this, as the marginal cost is below the average variable cost, you can see that the average variable cost is actually falling. If the marginal cost is above or more, average variable cost is going up. And you can see at this point, it is the minimum. This is precisely what the relationship between marginal and average is. Next. So I'm stuck with my slide here. It seems it's not changing. Let me see if I can actually move on to the next one. There is a system glitch, it seems. Yeah. So next, yes, there we are. So this is precisely what I was saying, that, and the same relationship can be again put up in context of again, now I need to undo this all, clear up. Here, all drawings, here we are. So this is how you can remember. I'll write it again in context, and please note, be it in context of the average variable cost, or in context of the average average total cost, the relation is the same. So I'm writing it again for you. MC, here it is. AC here, not MC here. And this is MC, MC, and MC. You can even remember the same idea with average variable cost. Same thing, MC, MC, and MC. Please note the difference is none in principle. I can just put it up here. This is my average cost, and this is my average variable cost. So if you see, the relation between the two is very clear. How marginal cost is related to average cost, just the way marginal cost is related even to average variable cost. So you normally get a question on this, so it'll be good if you prepared well on this particular topic. Now, what is the long run cost? The long run costs are definitely when you can actually change all the factors of production. That means the firm has actually already expanded. Maybe it had first institution, second, third, fourth, and that's precisely what we are talking of, long run. And in the long run, in other words, long run cost curve is like an envelope curve for the number of short run costs. It's also called a planning curve. Here it is. This is kind of important. You must know well the economies of scale, the diseconomies of scale. Economies is like the benefits of producing at a large scale, because you can negotiate better for, you can get bulk discounts when you're buying the raw materials. You can have marketing economies of scale, which means, you advertise one, but 10 of your firms benefit through that. one advertisement. So your costs actually go down because of that. You also have financial economies of scale, wherein you can arrange for more money much easily because you have more assets to offer. So these are some of the reasons for economies of scale. And the same thing, diseconomies is just the opposite, like disadvantages. So when an organization becomes too large, there are issues in that, and there would be, costs going up. So we call it rising costs, or maybe decreasing returns, and this is called increasing returns to scale, returns to scale, and it is called the decreasing costs. Just the opposite, increasing costs or decreasing returns to scale. Constant returns to scale is wherein the business is actually having, if it increases the inputs by 10%, it's having an increase in the output also by 10%. So the next one is, if you want to learn more about the formulas, how to do the calculation, you can refer to this particular link. This is another lecture pretty much on the lines that I have already explained. The other important topic is the market structures in microeconomics. So market structures, remember, in economics is defined based on the competition. And when it comes to the level of competition, there is maximum competition under perfect competition, and monopoly has practically no competition. So that's the key difference if you just had to really look into this. And the reason that there is more competition, why is there more competition under perfect competition? Because there are thousands of buyers and sellers, and they're selling exactly the same product. And not only that, they're selling exactly the same product, there is this kind of business is easy to start and close. And the best example you can remember is in terms of, your daily fruits and vegetables is the best way of remembering this idea. Monopolistic competition is close to the perfect competition in terms of the fact that it has got many sellers. However, it is not really close to perfect competition, or it can get closer to the other two because it is selling something different. Because it sells, if you think of the restaurants or your hairdressing salons or your daily hygiene products, all that is a part of your monopolistic competition market. And definitely it is relatively easy, but not as easy as it is in context of perfect competition. Simplest example, if I had to put it up, perfect competition, you can easily be a cleaner, right? So we all can start up cleaning services very easily, but starting up a restaurant could mean a little more effort and more money. So that is where relatively it is not so easy in terms of the entry and exit. And this is the reason that because these businesses are selling something different, they have a control on price. Oligopoly is typically there are very few sellers, and you can say the few sellers is 2 to 20. So within these 2 to 20 sellers, they could be selling something different or same product. The best example you may want to remember, car and petrol. So the petrol industry is also kind of oligopoly, very few sellers in principle, but they are selling exactly the same product. But differentiated can be cars. All car manufacturers do have a little bit of a difference in the very design or the pattern of their car. So entry conditions definitely are difficult. That's the reason that these businesses can be. And the monopoly is a single seller selling something completely unique. So in context of Sydney, you can think of City Rail or the Sydney ferries. So that's typically the common key concepts across the market structures that you may want to know of. Remember the cost curves. When it comes to the cost curves, they are pretty much the same along. In terms of the diagrams, so you do have the same bit marginal cost. You will have the same smile for your average cost. And so you don't have to do any different diagrams in this, no matter which market structure is it. Yeah. However, when it comes to the revenues, the revenue lines are going to be different because depending on what type of a market structure is it, is the business a price taker or a price maker? So just trying to find out the ways to clear it up. Yes. The next is in terms of the similarities, as I said, in terms of the cost, it is the same. Also in terms of the profit maximizing rule. What's the profit maximizing rule? Remember, MC equals to MR. So to decide on the output, that is the profit maximizing or loss minimizing output, is where marginal cost is equal to marginal revenue. So this rule is again the same across all the market structures. It doesn't change. The only thing that it changes maybe the marginal revenue line, how it is, because depending on the type of market structure it is. And alternatively, you can, and of course, MC must cut MR from below, must cut MR from below, and also from below. And also you may want to remember that the how to find out the profits, it's again the same rule. If average revenue is more than average cost, the firm is making supernormal profits. If the average revenue is less than average cost, the firm is making losses. Here it is making supernormal or economic profits, of course, normal profits. Okay, and then you can remember if the firm is having AR equals to AC, it is a case of normal profits. And also if the firm is making has the average revenue actually less than or equal to average variable cost, we call it the shutdown point. So you see, these all rules are the same no matter which market structure you're referring to. However, the differences will be sorry, this is yeah. So when it comes to the differences are in terms of the slope of the marginal revenue and the average revenue line. So remember, when it is a perfectly competitive market would have the same price, and because the firm is a price taker. So I'm again stuck with my pen here. This is it. So if you were to think of a price taker firm, just think of the price as maybe 5, 5, 5, 5. And then you can just do the calculations yourself. That is the total revenue. Make your own example quickly. I have my lecture already posted on this. But if you were to talk of, so this is a price taker firm, which is the market structure, perfect competition, right? So 1, 2, 3, 4. You can see how easy it is to make your own example here. 5, 10, 15, and 20. And then you will see the marginal revenue is here. So you can see here that the average revenue is equal to marginal revenue in this case, right? And this is where we say this is a case of perfect competition. And if you follow the same rules here, just maybe price and quantity, and if you define the profit maximizing output, this is what it is. Here it will be the profit maximizing output. And then if you want to find out whether the firm is making profits or losses, you just need to draw the average cost curve. If you drew the average cost curve below, as I'm drawing it here, you can see that this firm is making actually supernormal profits. So this is how pretty much you will need to remember the idea of difference in terms of the revenue lines. If this was a case of other market structure, naturally this pricing would be changing. So you may want to reduce this price, so you can make it the price being as 1, 2, 3, 4, or 5, 4, 3, 2, 1. You can choose any of the prices here, and based on that you can make your own example. And some more differences that I would like you to know on this before I just carry on. Again, I'm just kind of undo here, just a sec. Yes, so draw. So now referring to the differences for the perfect competition and monopoly, if you had to do it, and or any of the market structures. So just I'm writing down very quickly for the perfect competition or the monopolistic competition. I'm writing this in a short way here, and then the other one is your the monopoly or oligopoly, if you had to think of. Normally the comparisons and the similarities. So what is the similarity between perfect competition and monopolistic competition? We did see that there are large number of firms Also, not only that there are large number of firms, both the firms make only both the market structures. Firms make normal profits. Firms make only normal profits in the long run. Remember this, in the long run. So in both these market structures, the firms make only normal profits. Whereas when it comes to the similarity between monopolistic and monopoly, remember that both the firms, they sell something different. Monopolistic sells something different. Monopoly sells something completely unique. And both the firms are price maker. That's a important aspect here. So they're selling something different and they are both price makers. So typically you should be able to remember the similarities and the differences between the two. And based on the very first lecture slide, if you can recollect from there. And I would say our lecture on this one is, and I'll post the other one for you.